Hello, this is Angus Murray from Castlestone Management. I wanted to present to you 12 slides with regard to our weekly outlook on the economy and the US equity market. I've entitled the presentation, Interest Rate Cuts Could Be Sooner Than Expected. That is, that although the Federal Reserve is likely to increase interest rates again in July this month by 75 basis points, the market is now beginning to expect that the Federal Reserve will not increase interest rates at the rate that it was previously expecting, and in fact interest rate cuts could be occurring by the beginning of calendar 2023. In summary, inflation looks like it is coming under control. The US economy is showing signs of slowing, although there is still growth, and that is the reason the Federal Reserve will increase interest rates by 75 basis points in July, just to make sure that inflation is under control. The Chinese economy is slowly restarting, and we can see that in part by the movement of Chinese stocks. There is an easing of the supply chain problem, and I'll show you a chart with regard to that. And COVID is almost under control, or certainly evidence is that we can prevent the ongoing problems that COVID has caused in the last couple of years. I thought this was interesting, just taking a look at what happens normally after a drop of 20% in the S&P 500. And you can see that in 70% of the cases 1 year and 2 years out, the equity market has risen. And then taking a look 3 years out, in 89% of the cases, the equity market has returned on average around 29%. I don't see any reason that this time it will be any different, particularly when you strip out the data from 2008 when we had genuine excesses in the US economy. Inflation does look like it's come under control. The line there indicating that pricing pressure seems to have eased as of 3 months ago when you look at commodity prices. The Federal Reserve is now likely to be cutting rates in early 2023. In fact, to take a look at that, the blue line is expectations as of the 24th of June, whereas the white line is expectations as of the 5th of July. So there has clearly been a change in the last month in expectations with regard to when rate cuts will be coming for the US economy. The US housing market beginning to cool, and the Federal Reserve will act swiftly when it sees that coming under control. And here again, the Federal Reserve is clearly controlling inflationary expectations. So there's obviously a debate as to whether or not the US economy is going to go into a recession. It probably is going to go into a low period of growth as inflation comes under control, but the Federal Reserve will be very proactive, as it has been in trying to control inflation, to cut rates early 2023. Chinese stocks look like the worst is over, and we are beginning to see some movement up, particularly as the Chinese economy looks like it will get a further stimulus package with the introduction of another round of 220 billion of infrastructure bonds. We have seen the control with regard to COVID. Obviously, the introduction of a vaccine has caused a significant drop in the number of deaths, and that continues to decline. So although COVID will be around in our economies and affecting it to a degree, it does indicate, this chart does indicate, that we clearly have a strong level of control over COVID and the fears associated with that. Which of course brings us to one conclusion of that, is that the supply chain should be returning somewhat back to normal. Although it will take a while to return fully to normal, the index of global supply chain pressure, which comes from the New York Federal Reserve, is unmistakably declining, which means the world is returning to normal, and therefore we should see less inflationary pressures associated with supply chain bottlenecks. And although the number of investment banks have cut their forecasts with regard to the movement of the S&P 500 over the remainder of the year, and you can see here Oppenheimer cutting back their forecast for growth, we are still seeing, or it is implying, that the S&P 500 could rally 25% from this point going out to the end of calendar 2022. And then just lastly, reiterating those numbers with regard to what happens usually after a drop of 20% in the S&P 500. And as I indicated, I don't see any reason that this time will be any different from what we have seen in history. If you need anything further, by all means, please come back to us and we would be happy to answer any questions. Thank you.